You have to think of him like a program. He's programmed to follow a couple key mandates. So one is maximum employment long-term. The other one is inflation, and they define that as 2% is their target, that they kind of want to go a little bit above or a little bit below. They also actually have a third mandate, which is like moderate long-term yields. And then they have a fourth shadow mandate, which is financial stability, because they can't really operate if, say, the treasury market goes illiquid or the repo market breaks or something. So given his mandates, as they've seen, official inflation measures fall from 9% to 3%, while they've seen unemployment rise from a low level of 3.4% to a still fairly low level of 4.3%, the risks are clearly rotating in kind of the employment direction. Right now, real rates are fairly positive. When you think of him following a program, it makes sense that he would start mildly cutting rates to start balancing those mandates more. Whereas when unemployment was 3.4% and inflation was, 9% or 7% or whatever it was at that moment, it made sense for them to focus entirely on the inflation side. But now they're back more toward this mandate. Now, if you back up and ask me, should a central bank even set interest rates, right? So it's like, if you normally think price controls are not good, should they control the price of money? I would say no. I would disagree kind of with central banking as an institution. But given that it exists and given the mandates that he is kind of legally supposed to work in, it makes sense that he would start eyeing toward a gradual rate cutting cycle at this time. I doubt we're going to get to 0% interest rates again. It's possible, but I generally expect that much like we had a higher high in interest rates in the cycle, I think we're probably going to have a higher low in interest rates, which is that, maybe we cut back down to 2%, but we never cut down to 0. I could change that outlook based on what's happening, but that's kind of what I have set out as a base case, which is that we probably cut to a higher low before they kind of run into inflation issues again. We do have rising unemployment from a low level, and the ratio of kind of global capital stuffed into US capital markets is already equivalent to the late 90s. And so I generally think we're a little further along than kind of the mid to late 90s. I think we're either in the kind of the very late 90s or potentially in the 2000 equivalent. But of course, no analogy is perfect. I mean, in terms of fiscal dominance, basically the sheer force of fiscal deficits on the economy, the only comparable decade to now is the 1940s. In terms of just structurally running deficits that are way bigger than the amount of bank lending and way bigger than other forces. So there's shades of the 1940s here, but a kind of more recent cycle is a lot of global capital stuffed into the US markets, and yet the dollar index is kind of off its highs and we're entering a cutting cycle. So I generally view us as a little bit further along, but I try to follow data as it comes in and adjust accordingly. In 2019, when we started a rate cutting cycle, my base case was a capital rotation, but that got short-circuited by COVID in 2020. That kind of just scrambled any sort of rotation. And this is the first meaningful chance at a rotation in 5 years. They're going to adopt whatever they need to in order to keep, one, the banking system liquid, and two, keep government deficits financed. If you look at the Fed's projections, so the New York Fed projects what they expect their balance sheet to look like in the years ahead. They expect to go back to balance sheet increases by late 2025. And specifically, they expect to shift that more toward treasuries and less toward mortgage-backed securities. And part of that is maintaining what they define as ample reserves in the banking system. That basically over time, as bank assets increase, based on their regulation, the kind of the need for bank liquidity increases as well. And by doing quantitative tightening, they're pulling liquidity out. So a combination of mandating banks to hold, super liquid safe collateral, and then providing that collateral to them in many cases, or providing liquidity to them, not bringing down the liquidity floor too low, or pivoting once they do hit that floor like they did in, say, September 2019, whereas they kind of did again during the March 2023 banking crisis. They pivot whenever they kind of hit these liquidity floors. And I expect that's probably going to happen again sometime next year. So whether it's, regulations for banks holding that kind of safe collateral, or, very accommodative reserve policy, how deficits get monetized in the years and potentially decades to come. In the United States, the parties are very polarized, and both parties are different than a decade ago. So for example, the Republican Party back in the Paul Ryan era was interested in cutting entitlement programs. Now, part of the official Republican platform in 2024 is to not touch Social Security, not extend the retirement age, not cut it. And that used to be a Democrat position. The Democrat position is that plus more, right? So one of the few things that the Democrats and Republicans agree on now is basically don't cut the deficit. There's only a handful of things big enough to cut to meaningfully impact the deficit. So like cutting, education or cutting the FAA, those are like marginal. The big pools of spending that matter are Social Security, Medicare and Medicaid, defense, and then some adjacent things like veterans benefits. And practically all of those are not cuttable. So Social Security is now basically enshrined. And part of that's because recipients of Social Security, like people of that age, are the ones that actually vote in high ratios. So that's still the bulk of the voter base. So both parties consider it just like impossible to cut that. Around the margins, they can try to trim Medicare and Medicaid by kind of going after, like margins of healthcare companies and insurance companies and that, but it's really not meaningful. It's mostly a much deeper problem than that. Given geopolitical issues, if anything, defense is going to go higher, not lower. So that's something that, the two parties might disagree on where to put that, but neither side wants to cut defense meaningfully. Veterans benefits is basically locked in, and Republicans would very much oppose tax increases, and they were going to have a filibuster in place, which makes it very hard for Democrats to raise taxes, which they want to do. So a lot of that is locked in. And then the further thing is that even if they do, let's say it's somehow they decided next year we're going to meaningfully raise taxes and we're going to trim spending, and they somehow got the deficit from 7% of GDP down to 2% of GDP. Well, the problem is the US financial system is like our economy and our tax base is so financialized compared to most other countries, including Europe. And so generally speaking, when we have our asset prices go sideways or down for a year, our tax receipts start to go sideways or down for a year. And so ironically, by doing austerity, we could still fail to get the deficit down because we're actually kind of, even for trimming spending, we're potentially hurting revenue on the receiving side because it's so correlated with asset prices, partially because of tax changes we did in the 90s and partially because of how kind of top heavy our economic spectrum is. We have more wealth concentration and therefore more tax revenues tied to financial market performance. And so nothing short of a major restructuring would make any sort of dent in the deficits. And that's something that is very unlikely given the polarized state of politics. So I would describe less than a 1% chance that any sort of meaningful deficit reduction happens in the next 5+ years. And so I think that's a structural background phenomenon that as investors we have to deal with. If they just held rates where they are now, the interest expense would still increase because there's still longer term debt that's maturing and getting refinanced at these higher rates. And so, over the past 2 years, a lot of the debt that was in T-bills, so that refinanced very quickly, but there's still a very long tail of older debt that's refinancing at these higher rates. And so if you cut interest rates moderately, down to 4%, 3.5%, a lot of that maturing debt is still kind of maturing at the same or higher levels, like a 10-year treasury from 10 years ago during the very low interest rate environment of the 2010s, for example. That's low yielding debt that's maturing into similar or higher levels now. Now, T-bills could go down to some extent, but that's only a certain percentage of the debt. So I generally think that unless we go back to a kind of structurally zero rate environment, which I don't see as a base case, so failing that, I think interest expense will stop going up at the rate that it has been, but that it's kind of at these structurally elevated levels. And then because we're still running very large deficits, we're still accumulating debt, which is interest bearing. So I think that's more of a permanent feature because we had 40 years of rising debt as a percentage of GDP, but it was offset by not just sideways, but falling interest rates. So if you double your debt, but you have your interest rate, your expenses stay roughly the same. And we had 40 years of that phenomenon. So now the fact that we're kind of probably going to chop along sideways in interest rates while debt is still going up means that we don't really have that offset anymore. So I think that high interest expense is structurally part of it now. And if they do cut all the way to zero, then that basically sends assets like gold and Bitcoin to the moon, because if you're running 7% of GDP deficits and interest rates are zero, that's trillions of dollars that then wants to get into scarcer assets. So they can play it how, multiple different ways, but it all kind of points to the same investment outcomes from my perspective. Warren Buffett is receiving Social Security right now, right? Because it's not set up like a insurance, really. It's set up like a pension, right? That people paid into it and therefore they get money out of it regardless of whether they're rich or poor when it comes time to get money out of it. So one option is to trim off the top 20% or so that don't really need it. Even that would be unpopular. There's just not really great solutions. The other option is, and they always kind of hope for this, is just productivity increases. If we enter a world of cheap robots, it becomes easier to care for all the people in nursing facilities. It's kind of a funny example, but basically any sort of marginal productivity increase helps offset the pace of large monetized fiscal deficit. You can think of inflation as money supply growth minus productivity. If anything, the base case for inflation should be zero. If we had finite money, things should get marginally cheaper every year because our productivity, outside of war, is generally going up. We have more industrial capacity, we have more technology, we have more organization, which then takes a step back during wars, but generally is on this kind of structural march higher. And that's offset by the fact that developed markets on average run 7% per year money supply growth, obviously higher during the COVID years, lower now that, at the moment because central banks are trying to push back on it, but long term about 7%. And so from their perspective, if they want to maximize their chances of making this work, it's, one, you have to promote lots of new energy. You have to be a very conducive place for technology to grow, monetize fiscal deficits. And because ultimately what is owed, in some sense, inflation adjusted. They don't owe a certain dollar amount of medical services. They owe a certain set of medical services, kind of regardless of price. And so security payments are linked to inflation. So they can tweak their algorithms all they want, but basically a lot of this is inflation adjusting one way or another, which means either have to grow your way out of it or you default in some way, either obviously or through, inflation, like not increasing like the payments as much as real inflation's happening. So we'll see which path they end up choosing, but it's not going to be a fun path either way. I think it's a variable. I don't think it's that utopian. I think the offshoring and automation of the past 40 years was a very powerful disinflationary force, right? So instead of Americans in like Detroit making cars, you offset that to Japan, which at the time, especially back then was cheaper. And instead of making, sneakers in the US, you make them in China and Vietnam. And so, one person can do the work of 4 people because it's automated. We've already automated a lot of blue collar work or put it into cheaper labor markets. And basically what AI can do, I think in the investable time horizon, it can start to chip away at white collar work. It can, one white collar employee can do the work of more because they have a bunch of AI assistants offsetting some of their analytics or their thinking or, things like that. A lawyer doing legal research, having AI helper, it makes things a lot, more efficient. So I think that we could see a similar phenomenon to white collar labor as we saw to blue collar labor. I think robots are an energy intensive, challenging thing. I think that's robot in kind of the natural world is a longer term thing. But I think that the automation of white collar work is a lower hanging fruit for now.